I need you to stop what you're doing and pay attention to this, because what I'm about to share could fundamentally change how you think about your retirement security. And I'm not being dramatic here. The numbers I'm going to show you are real, they're current, and they're affecting millions of people just like you right now. Let me start with something that happened just a few months ago that barely made the news. A major pension fund in the Midwest sent out letters to its retirees. Routine correspondence, right? Except these weren't routine letters. They were notifications that monthly payments were being cut by 30%. Not reduced gradually over time, cut immediately. 30% less money hitting bank accounts the following month. Now, imagine you're one of those retirees. You've worked 35 years. You did everything right. You contributed to your pension every single paycheck. You planned your retirement budget around that monthly payment. And suddenly, without warning, a third of it disappears. How do you adjust? Do you cut your medication? Your groceries? Your utilities? This isn't a hypothetical scenario. This is happening right now across America. And here's what nobody's telling you. It's about to get much worse. See, there's a fundamental problem with how pension systems work that most people don't understand. And the people managing these funds are counting on you not understanding it. Because if you did, if you really grasped what's happening behind the scenes, you'd be demanding answers. You'd be taking action. You'd be protecting yourself. Let me explain how we got here. Traditional pension funds operate on a simple premise. They take contributions from workers and employers, invest that money, and use the returns to pay out benefits to retirees. Sounds straightforward, right? But here's the catch. These funds make assumptions. Big assumptions. They assume they'll earn a certain rate of return on their investments every single year. Most pension funds assume they'll earn somewhere between 7% and 8% annually. Now, why does that matter? Because when they're calculating whether they have enough money to pay all the benefits they've promised, they're using that 7-8% assumption. They're essentially saying, we have X amount of money today, and if we earn 7-8% every year, we'll have enough to pay everyone. But what happens when they don't earn 7-8%? What happens when markets crash? What happens when interest rates stay low for years? What happens when their investments underperform? They fall short, way short. And that shortfall has a name: unfunded liabilities. It's the gap between what they've promised to pay and what they actually have. And right now, that gap is absolutely massive. We're talking about trillions of dollars in unfunded pension liabilities across the United States. State and local government pensions alone are underfunded by over $1.3 trillion. That's trillion with a T, and that's just the public sector. Private sector pensions have their own crisis brewing. Here's where it gets really concerning. These pension funds have been playing a dangerous game for years. When they couldn't hit their 7-8% return targets through traditional investments like bonds and blue-chip stocks, they started taking bigger risks. They moved into alternative investments, private equity, hedge funds, real estate ventures, riskier and riskier bets trying to chase those returns. And for a while, it worked. Sort of. They were able to paper over the shortfalls. But now we're seeing the consequences of those risky bets. Some of those investments are blowing up. Some are illiquid, meaning the pension funds can't even access the money when they need it. And some were just bad investments from the start. Let me give you a specific example. There's a state pension fund that invested heavily in a real estate development project a few years ago. Big, ambitious project. Shopping centers, office buildings, residential units. The pension fund put in hundreds of millions of dollars. The projections looked great on paper. 12% annual returns. Everyone was excited. Fast forward to today. That development is half empty. Office space demand collapsed. Retail is struggling. The project is worth maybe 40 cents on the dollar. And that pension fund? They're stuck. They can't sell. They can't get their money out. And they're still on the hook to pay retirees every single month. Multiply that story by hundreds of similar situations across different pension funds, and you start to see the scope of the problem. But here's what really keeps me up at night: the demographic time bomb. Baby boomers are retiring in record numbers. Over 4 million Americans turned 65 this year alone. That's the highest number in history, and it's going to stay at that level for years to come. What does that mean for pension funds? It means more people drawing benefits and fewer people contributing. The ratio of workers to retirees is collapsing. Some pension funds used to have 5 or 6 active workers for every retiree. Now they're down to 2 or 3 workers per retiree. Some are approaching 1-to-1. Think about that math for a second. If you have one person contributing and one person drawing benefits, and the person drawing benefits is taking out more than the person contributing is putting in, how long can that system survive? It can't. It's mathematically impossible. And this is where we get to the really uncomfortable truth that nobody wants to talk about. When pension funds run out of money, there are only a few options. None of them are good. Option 1. Cut benefits. That's what happened with those retirees I mentioned earlier. Their monthly checks got slashed by 30%. And they're not alone. Dozens of pension funds have already implemented benefit cuts. Dozens more are considering it. Option 2, increase contributions from current workers. But there's a limit to how much you can squeeze from people who are already struggling with inflation, stagnant wages, and rising costs of living. Plus, many of these pension funds are for government workers, which means those increased contributions come from taxpayers. Option 3, government bailout. And this is where it gets political and messy. Some pension funds are hoping for federal intervention. They want the government to step in and make them whole. But that means taxpayers across the country would be on the hook for pension promises made by states and municipalities they don't even live in. Option 4. The pension fund goes insolvent. Benefits stop. Retirees are left scrambling. And yes, there's a federal insurance program called the Pension Benefit Guaranty Corporation that's supposed to step in. But even that program is underfunded and has limits on what it will pay. None of these options are acceptable. But one of them is going to happen. In fact, all of them are already happening to different pension funds across the country. Now, I know what some of you are thinking. My pension is different. My pension is secure. I worked for a big company. I worked for the government. They wouldn't let this happen to me. And I understand that thinking. I really do. But I need you to check that assumption, because the retirees who are getting their benefits cut right now, they thought the same thing. They trusted the system. They believed the promises. And now they're facing a retirement crisis they never saw coming. Here's what you need to do right now. First, find out the funding status of your pension. Most pension funds are required to publish annual reports. Look for something called the funded ratio. That's the percentage of assets they have compared to their liabilities. If your pension is below 80% funded, that's a red flag. If it's below 70%, that's a serious warning sign. If it's below 60%, you need to be making backup plans immediately. Second, understand what protections you have. If your pension is a private sector pension, it's likely covered by the Pension Benefit Guaranty Corporation. But know the limits. The PBGC has maximum benefit amounts it will pay. If your pension benefit is above those limits, you could lose the excess if your pension fails. If your pension is a public sector pension, state or local government, the protections are different. Some states have constitutional protections for pension benefits. Others don't. You need to know where your state stands. Third, and this is critical, do not rely solely on your pension for retirement income. I don't care how secure you think it is. I don't care how well funded it appears. The landscape is changing too rapidly and the risks are too high. You need to be building additional retirement security outside of your pension. And this is where I want to talk about something that's becoming increasingly important in this environment. Quick aside here, because this is relevant to what we're discussing. If you're sitting on $100,000 or more in retirement savings, whether that's in a 401k, an IRA, or other retirement accounts, I've put together a comprehensive guide on how gold IRAs work. It's completely free and you'll find it in the description below. It covers how you can get physical precious metals into your retirement account without triggering tax penalties, and why more and more people are considering this as part of their retirement strategy. It's worth looking at if you're concerned about the issues we're discussing here. Now, back to what's happening with pensions, and why this matters so much right now. The reason I bring up alternative retirement strategies is because of what's happening in the broader economic environment. The same forces that are crushing pension funds are affecting everyone's retirement security. And understanding these forces is crucial to protecting yourself. Let's talk about inflation. Real inflation, not the sanitized numbers you see in official reports. Your pension was calculated based on certain assumptions about the cost of living. But what happens when the actual cost of living increases faster than your pension adjustments? Most pensions have some form of cost of living adjustment, or COLA. But these adjustments are typically capped, maybe 2% or 3% per year maximum. Now, if actual inflation is running at 5%, 6%, 7% or higher, your purchasing power is declining every single year. Your pension check might stay the same or increase slightly, but it buys less and less. I've talked to retirees who tell me their pension seemed adequate when they first retired, but 5 years later, 10 years later, they're struggling. The same monthly payment doesn't cover what it used to. Groceries cost more. Utilities cost more. Healthcare costs have exploded. Insurance premiums keep climbing, and their pension adjustment hasn't kept pace. This is the silent crisis within the crisis. Even if your pension doesn't get cut, even if the fund stays solvent, you could still find yourself in financial trouble because of inflation erosion. And here's something else that's not being widely discussed. The investment environment that pension funds are facing right now is unlike anything we've seen in decades. For years, pension funds could rely on bonds as a stable, predictable source of income. Government bonds, corporate bonds, they were the bedrock of pension fund portfolios. But what happened when interest rates went to zero? When the Federal Reserve pushed rates down to historic lows? Those bonds stopped generating meaningful returns. A pension fund that used to earn 5% or 6% on its bond portfolio was suddenly earning 1% or 2%. That's a massive shortfall when you're trying to hit a 7 to 8% overall return target. So pension funds had to take more risk. They had to move into stocks, into alternatives, into investments they wouldn't have touched in previous decades. And that increased risk exposure means increased volatility. It means bigger potential losses when markets turn. We saw this play out during the financial crisis. Pension funds got hammered. Some lost 25%, 30%, even 40% of their value in a single year. And while markets eventually recovered, those losses had lasting impacts. Pension funds that were 90% funded before the crisis dropped to 70% or 60% funded, and many of them never fully recovered. Now, here's the scary part. We could be heading into another period of market stress. The economic indicators are flashing warning signs, yield curve inversions, credit spreads widening, corporate debt at record levels, consumer debt at record levels, government debt at levels we've never seen before. If we hit another major market downturn, pension funds are going to get crushed again. And this time, they're starting from a much weaker position. They don't have the cushion they had before. They're already underfunded. They're already stretched thin. Another major hit could push many of them over the edge. And it's not just market risk. There's also political risk. Pension reform has become a hot-button political issue. Some politicians are pushing for benefit cuts. Others are pushing for increased contributions. Others are pushing for complete overhauls of the pension system. The problem is there's no consensus. There's no clear path forward. And while politicians argue and debate, pension funds continue to deteriorate. Retirees continue to face uncertainty, and the crisis continues to build. Let me share another story that illustrates how bad this can get. There's a city that declared bankruptcy a few years ago. Not a small town, a major American city. And one of the biggest factors in that bankruptcy was pension obligations. The city had promised generous pensions to its workers for decades. Police officers, firefighters, teachers, sanitation workers. All of them were counting on those pensions. But the city's pension fund was massively underfunded. The city couldn't afford to make the required contributions, and eventually the whole system collapsed. When the city went through bankruptcy, retirees saw their pensions cut by up to 40%. People who had worked their entire careers for the city, who had been promised secure retirements, suddenly found themselves with a fraction of what they expected. Some had to go back to work in their 70s, some lost their homes, some had to move in with family members. And here's the thing. That city isn't unique. There are dozens of cities and municipalities across the country facing similar situations. Some are already in bankruptcy, others are teetering on the edge, and in every case, retirees are the ones who suffer. Now, I want to be clear about something. I'm not trying to scare you. I'm trying to inform you. Because the worst thing you can do in this situation is stick your head in the sand and hope everything works out. Hope is not a strategy. Ignorance is not protection. You need to understand what's happening. You need to assess your own situation. And you need to take action to protect yourself. So let's talk about what that action looks like. First, diversification. If your retirement security is entirely dependent on a single pension, you're taking on enormous risk. You need multiple streams of retirement income. Social security, personal savings, investment accounts, maybe rental income or part-time work. The more diversified your income sources, the more protected you are if one of them fails. Second, liquidity. You need access to cash and liquid assets. If your pension gets cut or delayed, you need to be able to cover your expenses while you figure out your next move. Financial advisors typically recommend having 6 to 12 months of expenses in an emergency fund. For retirees facing pension uncertainty, I'd argue you need even more. 12 to 24 months would be better. Third, hard assets. This is where things like precious metals come into play. When pension funds fail, when currencies lose value, when financial systems face stress, hard assets hold their value. Gold and silver have been stores of value for thousands of years. They're not dependent on any government's promise or any institution's solvency. They're tangible, they're liquid, and they're recognized worldwide. I'm not saying you should put all your money into gold and silver. That would be just as risky as putting all your money into a pension. But having a portion of your retirement savings in physical precious metals provides a hedge against the exact risks we're discussing. Currency devaluation, institutional failure, economic instability. Fourth, stay informed. The pension crisis is evolving rapidly. New developments happen every month. Funds that seem secure today could be in trouble tomorrow. You need to be monitoring your pension fund's status regularly. Read the annual reports. Attend the meetings if they're open to participants. Ask questions. Demand transparency. Fifth, consider your options. If you're still working and you have a pension, find out if you have the option to take a lump sum distribution instead of monthly payments. Some pension plans offer this. And depending on your situation, it might make sense to take the lump sum, roll it into an IRA, and manage it yourself. At least then you have control. You're not dependent on the pension fund's investment decisions or solvency. If you're already retired and receiving pension payments, look into whether your pension offers any kind of buyout option. Some funds, when they're facing financial stress, will offer retirees a reduced lump sum in exchange for giving up future monthly payments. It's not ideal, but it might be better than risking a larger cut down the road. Sixth, plan for the worst case. I know that sounds pessimistic, but it's prudent. What would you do if your pension was cut by 25%, by 50%, by 75%? What expenses could you reduce? What assets could you liquidate? What alternative income sources could you tap into? Having a plan, even if you never need to use it, gives you peace of mind and puts you in a position to act quickly if necessary. Now let's zoom out and look at the bigger picture, because the pension crisis isn't happening in isolation. It's part of a larger shift in how retirement works in America. For most of the 20th century, retirement security was built on a three-legged stool: Social Security, employer pensions, and personal savings. But two of those legs are wobbling badly. Social Security is facing its own funding crisis, with the trust fund projected to be depleted within the next decade. And as we've discussed, pensions are failing left and right. That leaves personal savings as the primary leg of the stool. And for most Americans, personal savings are woefully inadequate. The median retirement account balance for Americans approaching retirement is less than $200,000. That might sound like a lot, but when you're trying to generate income for 20 or 30 years of retirement, it's not nearly enough. So we have a perfect storm brewing: pensions failing, Social Security under stress, and inadequate personal savings. And on top of all that, we have inflation eroding purchasing power, healthcare costs exploding, and longer life expectancies, meaning retirement savings need to last longer than ever. This is why I'm so passionate about getting this information out there, because the window to prepare is closing. If you wait until your pension fund announces benefit cuts, it's too late. If you wait until Social Security gets reduced, it's too late. You need to be taking action now, while you still have time to build additional security. And here's something else to consider. The pension crisis is going to have ripple effects throughout the economy. When millions of retirees see their incomes cut, they're going to spend less. They're going to cut back on discretionary purchases. They're going to reduce their standard of living. And that reduced spending is going to impact businesses, which is going to impact employment, which is going to impact tax revenues, which is going to make the pension crisis even worse. It's a vicious cycle. And we're already seeing the early stages of it play out in communities where pension cuts have hit. Local businesses struggling because retirees have less money to spend. Property values declining because retirees are downsizing or moving to cheaper areas. Tax bases eroding because there's less economic activity. This isn't just a retirement crisis. It's an economic crisis. And it's going to affect everyone, not just retirees. So what's the solution? Honestly, there's no easy answer. The pension crisis has been building for decades, and it's going to take decades to fully resolve. But on an individual level, you can protect yourself. You can take control of your own retirement security instead of relying on institutions that may or may not be there when you need them. Start by educating yourself. Understand how your pension works. Understand the risks. Understand your options. Then take action. Build diversified income streams. Accumulate liquid assets. Consider hard asset protection. Create backup plans. And most importantly, don't wait. Every month you delay is a month of lost opportunity to build additional security. Every year you put off taking action is a year closer to retirement, with less time to recover if things go wrong. I've seen too many people who thought they were set for retirement only to have the rug pulled out from under them. I've talked to too many retirees who are now working part-time jobs in their 70s because their pension didn't deliver what was promised. I've heard too many stories of people who had to completely change their retirement plans because the institutions they trusted failed them. Don't let that be your story. Take control now. Protect yourself now. Build the retirement security you deserve, independent of any institution's promises or any fund's solvency. The pension crisis is real. It's serious, and it's not going away. But you don't have to be a victim of it. You can be prepared. You can be protected. You can have the secure retirement you've worked your entire life to achieve. The choice is yours. You can hope everything works out, or you can take action to ensure it does. You can trust the system, or you can build your own security. You can wait and see what happens, or you can prepare for whatever comes. I know which choice I'd make, and I hope after hearing all of this, you know which choice you'll make too. Your retirement security is too important to leave to chance. It's too important to trust to institutions that are already showing cracks. It's too important to gamble on promises that may not be kept. Take action today. Protect yourself today. Build the retirement security you deserve, starting right now, because the time to prepare isn't when the crisis hits. It's before, and that time is now.